Hello, everyone. Happy Friday. Today on the final bar, we'll wrap the week. We'll focus on how this market has evolved from last Friday to this Friday. Sort of renewed strength going into the close with the S&P powering above 4540. We'll talk about these overall market conditions. It's been a choppy phase that's netted out in the short term for sure, showing some renewed strength. We'll look at the returns week to date, but also the strength and energy, even utilities today, pushing stocks higher. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the technical analysis toolkit, using the power of stock charts to better understand the world around us and make sense of these markets in uncertain times. I think the big discussion that I've had with many of my guests in recent weeks, and I've certainly had internally, is this conflicted environment we see in stocks. You're seeing renewed short-term strength for sure with energy stocks, which have been the story year to date, now resuming their move to the upside. A lot of names up significantly, up mid double digits year to date, and having significant runs and adding to those runs, and even in other sectors like materials and elsewhere. On the other end, you still have an overall bearish environment by some measures. The Nasdaq down a little bit today. So stocks going higher, but technology really not as much as you might want if you're more growthy with your positioning, not really participating in the market. So what's right? Is this a short-term rally within a bear market phase, or is this the beginning of the end of the bear market phase and beginning of the bull market phase? It's tough to really figure all of that out in moment-to-moment analysis, but that's the benefit of doing a weekly view like we will do today. Let's focus on how things have changed from last Friday to this Friday. We have great guests on the show. I had a lot of fun. I'm thinking of my conversation with Roman Bogomazov yesterday on Bitcoin, conversation with Peter Brandt earlier this week on Bitcoin. Some really great debates with our guests. Next week on Tuesday the 29th, we have David Auerbach from the Daily Repeat. On Wednesday, March 30th, Mark Newton from Fundstrat Global Advisors. On Thursday the 31st, Tim Tashler from Sprott Global Advisors. Let's continue on with our next segment today called Wrap the Week. What we like to do is focus on the last 5 trading days, last Friday to this Friday. What really changed? Let's focus on those charts here in a moment. But first, I want to get to a poll that we asked you recently on social media. Also on our live stream page on StockCharts.com, we always have a poll running. We asked you recently this week, will the next 10% move in the S&P 500 be higher or lower? Super straightforward. What did we say? About 56% said lower. 44% said higher. I'm actually not super surprised. I had a webcast earlier this week that I did with market misbehavior. It's about the same. It's about a 60-40, geared more towards lower than higher. If you think about it, we'll bring up a chart of the S&P 500 here in a few moments. If you think about it, 10% higher from current levels puts us almost to 5,000. That'd be like 4950-ish. If I'm doing some quick mental math in my head. On the downside, that would be around that'd be below 4,000, right? That'd be down to the 50% retracement level. We're about to that point, maybe a little above there. So you're basically making new highs for the year or new lows for the year. Which one of those is first? And you guys, 6 out of 10 of you said basically new lows. I did not vote in that poll. If I did, I probably would say that as well. And the reason is because, whether or not you see some signs of strength in the last week and a half, the question is there enough sustained upside momentum to get us above previous all-time highs? I could absolutely be wrong, but I'm doubtful of that being the case. I'm super impressed by the S&P regaining its 200-day moving average. I'm super impressed by the renewed strength you see Thursday and Friday this week with the S&P pushing above 4,500. We're getting closer and closer to that 4,600 level. And as I've talked about, I think when the S&P or any chart really regains a key level of resistance and is able to push above it and hold it, that has meaning. That tells you something's different. So the S&P has really been below its 200-day moving average since mid-February. Now, about 5 weeks later, we're able to get back above it. It's starting to show some signs of some signs of strength for sure, and sustained strength. And again, the question is, can it get above 4,600? I think that's still an open question. I don't know if we can declare that just yet. But next week, we are absolutely. I think that'll be the main area of focus. Can we remain above the 200-day and get above some of those previous swing highs? Let's look at our wrap the week chart. So, in one chart, we like to summarize the performance of these major asset classes for the last 5 trading days. So, we're starting the clock last Friday. If you follow my voice and the mouse, you'll be able to see where we're at. In black here, right about in the middle, is the S&P 500. So, over the last week, gaining about 1.8%. It's actually a pretty good week for 2022. A lot of weeks have obviously been net negative for stocks, but this one actually showed some strength. Gold coming off a little bit puts it right about at the same. It's just below that. It's still around 1.7% up for the week. A number of things underperformed the S&P this week. We have in green the U.S. dollar. That's using the UUP ETF, which was up 0.6%. In purple, we have small cap stocks, the Russell 2000 ETF, which was down 0.3%. In orange, we have emerging markets down 0.7%. In red, we have bond prices, the TLT, down 3.6%. That was the worst performer of the bunch here. So this week has certainly been a renewed focus on interest rates and the prospect of higher rates, the prospect of higher inflation. You see gold prices going up, you see interest rates, bond prices coming down, and that's sort of an inflationary environment type of combination to expect. Everything else outperformed the S&P this week. In pink, we have the Nasdaq 100, which even with some signs of weakness at times, actually outperformed the S&P this week, up 2.4%. In blue, we have Bitcoin, which is up 6.5%. The biggest performer this week was crude oil prices, up 8.2%. That's using the USO as a proxy for crude oil prices. And again, energy year to date has been the story, I would argue, or one of the key stories. Strong commodity prices, and certainly strong crude oil, and how that's translated to outperformance for the energy sector. I'm often asked in this sort of environment, have we missed the move? Is it too late to buy energy stocks? I would argue, I mean, no. I think on its own, just the fact that something like that has done so well is not a reason to avoid it. And I think market history has shown that strength in stocks tends to lead to further strength in stocks. And so I wouldn't be afraid to look at some of the charts in energy and look at those opportunistically to see where you can allocate to trends that are working. I did a presentation earlier today for Fidelity Investments. We talked about the three main questions you should be asking. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends are potentially over. I would be following trends like energy and materials and others that are working, and assume that there's a potential further strength in some of those areas. To complete this wrap the week segment, let's go to the Mindful Investor live chart list. And if you're just new to the show, if you go to my page on StockCharts, which means go to the articles tab, you'll find my blog called the Mindful Investor, and you'll get to this list of charts. There's a little gray button at the top of my blog that gets this list of charts. It's the Mindful Investor live chart list. I keep these updated pretty regularly, and it sort of summarizes my perspective on the big picture, on macro themes, and some key ratios that I think are important to watch, as well as things like breadth and sentiment that are pretty important. We'll start with the market trend model. For me, this looks at the S&P 500 on 3 different time frames: long-term, medium-term, short-term. There's no change this week from what we saw last Friday. I update it every Friday after the close. The long-term model remains bullish. The medium-term model remains bearish. The short-term model remains bullish. And when I say long-term bullish, that's about how that chart looks to me. Medium-term bearish is pretty much how I've been interpreting year-to-date performance. And short-term bullish, I think that's about right. The medium-term model really close. And if you see further strength in stocks next week, what could happen here is the S&P gets above 4,600, gets us above the February highs. The medium-term model for me would turn positive, which would most likely mean market trend model is positive on all time frames, and it would tell me to go risk on and be looking opportunities to the upside. I still see what we're seeing. I would have to label it as more of a bear market rally until we start eclipsing those levels, and we get more participation from breadth, which we'll look at here in a few moments. We looked at the daily chart of the S&P just a little earlier, but I just reiterate, 4,600 is a really important level. Getting above that Fibonacci retracement, getting above the February highs, I think is pretty important. A lot of individual names having a similar pattern where they made a high in February and now attempting to eclipse that. But to be honest with you, I'm surprised and impressed and completely acknowledging the short term strength that we've seen in stocks. The question now is that it? Is that the run? Things I would be looking at here, besides eclipsing previous highs, do we hold the 200-day moving average going into next week? The fact that we've broken above it Thursday and going higher today tells me that that's pretty likely that we actually hold the 200-day moving average. The RSI is right at 60; it's just a tick above there, and I want to see if that can get above. Right, what you want if the market is in a bullish phase is the RSI gets above 60, ideally even gets overbought during the uptrend, right? That's the sign of a healthy bull market phase with an expansion or an influx of buying power. We're not necessarily able to declare that just yet, which is why I think you can still label it as a counter trend rally here. Breadth conditions are important as well. We'll see these breadth conditions improve when we run the data a little later today. Right now these are only updated through Thursday's close, but I'd pay attention to the February highs here as well. The S&P breaking above on a price basis is important. The breadth conditions breaking higher as well would be important because that tells you about participation. I still have these color coded red because they haven't eclipsed their February highs yet. If and when they start to do so, I'll start changing them to a neutral amber color, recognizing the fact that they've showed strength, and they'd have to make a new high then to get back to the green color of a fairly supportive breadth. At this point, I think it's still wait and see mode. I think the market rolls over next week. This will look like just a classic bear market rally phase for sure. Other breadth measures we can look at very briefly. It's about 52% of the S&P members, again, as of Thursday's close, above their 200-day moving average, about 58% above their 50-day. Both of those most likely tick at least a little bit higher as of today's close, as of Friday's close. Getting above 50% and staying there would be key as well. And again, that's why I can't just wholeheartedly say we're in a raging bull market again, because some of these breadth indicators haven't gotten above sort of my classic levels of bullish environment, right? These remain below 50% in a bearish phase. They get back above 50% in a bullish phase. Particularly this one, which is the percent of stocks above their 200-day. I'd like to see that get back above 50%. If you're bullish, you want to see an expansion in new 52-week highs. We've seen a little bit, but not enough to get really excited about. Why we saw more new 52-week highs back here in March, in the beginning of March, as opposed to now, where the S&P is actually much higher. That was at S&P 4400. We're seeing more new highs than we were here, and it tells you a lot of stocks are not quite able to eclipse their previous highs. Bullish percent index remains below 70%. 70% is what we call bull confirmed. That would be a validated bullish market phase. We're not quite there yet. We talked about sentiment a good amount yesterday, so I don't want to pound that any more than I think we've already covered. But if you missed that, I go back to Thursday's show. We talked about this big shift in sentiment from very bearish sentiment to more neutral. Really, when you think about the spreads, it's almost even between bulls and bears, which is interesting. Let's talk about interest rates, because when I'm asked about key themes to pay attention to, what are the most important charts that investors should know about? And I've done a number of presentations this week for Fidelity, for the Money Show, and elsewhere, and I've been asked that sort of question or some version of that question. And this is usually the one I start with. Besides a chart of the S&P or some of the basic price-based analysis that we've done, it's interest rates and thinking about a rising rate environment and what that might mean for your portfolio. If you've not done so yet, I would look at this chart, which shows you 10-year interest rates, obviously going much higher. We could back this up further to show that back in 2018, end of 2018, we got even further than this, right? We got to 3.25%, I want to say, on the 10-year. But at the bottom, this is the ratio of value versus growth. Which side of the market, if you simplify and look at one versus the other, and what it's showing you is since November, which is essentially the market peak by most measures of breadth and momentum, value stocks have been soundly outperforming. Obviously, energy's done very well. Some of the growthy sectors like communication services have been struggling. This has been a broader relative performance story of value over growth. If you believe that the Fed is going to keep raising rates, if you believe that interest rates in general are going to go higher, you are fighting big time if you're owning a bunch of growth stocks in this environment. And so you have to remember that that is a potential headwind to performance. So what I would do is look at this chart, think about what a rising rate environment would mean. Think about what your portfolio would most likely do if the 10-year yield goes to 2.75%, 3%, 3.25%. I don't know if all of those are necessarily going to happen, but I do know it's an important exercise to do to see whether or not how well your portfolio might do. Finally, a little downtick in consumer discretionary versus consumer staples. This pink line is an important one, and we'll leave the wrap the week segment here. I think a rollover in this ratio shows you investors are rotating more to the defensive side of the coin, which is a bit of a concern. Before we go to a commercial break, as we wrap up that segment, I just want to mention one incredible personality in the financial industry that we lost unfortunately this week. Ned Johnson, Edward Johnson III, is the former chairman of Fidelity Investments. I had a pleasure of working with Ned Johnson. We would call him the chairman in my time at Fidelity from 2008 to 2016. He actually hired me, and it was hilarious that someone like the chairman with all the responsibility took the time to meet the new head of technical research because technical analysis and market history was so important to him. And I will tell you, spending many hours with him in the Fidelity chart room, we would get little to no warning before impact. We would get a call from his assistant saying the chairman is on his way over, get ready. And we would get a couple of us over into the chart room to talk with him. And he would ask incredibly detailed and poignant and challenging questions about market history, deep thoughts about different sectors and themes and price data and sentiment data that we should try to capture. He inspired us to dig into all sorts of potential themes, thinking about market history, what types of stocks perform well in different environments, and talk about an advocate for technical analysis, an advocate for market history and data visualization. We were able to improve the chart room greatly, incorporate all sorts of new technology and digital signage, celebrating the history of technical analysis using the leadership of Ned Johnson. So it's a tough loss, I would think, to the community of technical analysis, and we very much appreciate the legacy he left behind of forwarding the practice of technical analysis. We'll be back with you in a minute after the break. Hello, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close as we break down the market environment using the power of stock charts, using the technical analysis toolkit to better understand the world around us. A couple quick comments before we get to our mailbag segment in a few moments. Number one, all of the questions I'm about to share with you came from viewers like you sharing some questions that you ran into as you were analyzing your own charts. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. Hope to answer one of yours in our next mailbag segment, Tuesday of next week. Also, go to stockchartstv.com. We have so much great content. I'm super proud of the StockCharts TV team. We did a series of special events celebrating the history of women investors and women on Wall Street. We did an episode of The Pitch recently. We also did Chart Madness 2022, four of us picking stocks and debating the strengths and weaknesses of different technical configurations. I would encourage you to go to stockchartstv.com. It is free to access all of that great content. Or on your mobile device, just search for Stock Charts TV on demand. Our next segment is the Final Bar mailbag. As a reminder, get your questions to us via email, thefinalbar@stockcharts.com. Let's go to question number one. Has it been proven that higher interest rates are good for value stocks? If so, and knowing the Fed is going to raise interest rates several more times this year, does it mean RPV is going to outperform RPG? In an environment of rising interest rates, will RPV outperform SPY, meaning will value stocks outperform the S&P 500? So I will say, I'll bring up a chart, and as I'm doing that, I will tell you, you're using a very dangerous word, which is will. Will something happen? And I cannot, in all intellectual honesty, say any one particular thing will happen. I can tell you what's most likely to happen. I can tell you the general tendencies about some of these different things happening and not. I cannot tell you with absolute certainty what is going to happen. So let me start with that major league qualifier. So I don't usually talk about what will happen or what won't happen But I do like to tell you about the tendencies, and I will tell you it's all about the what I would call headwinds and tailwinds. Certain types of stocks tend to do well in certain environments. This chart that I'm showing you here sort of shows that pretty clear relationship between interest rates and value versus growth. So when this line is going up, value is outperforming growth. When it goes down, value is underperforming growth. Now, if you look carefully, you will find times, particularly on shorter time frames, where interest rates are going higher and value stocks are actually underperforming. And the opposite, you can see when interest rates are coming down and value stocks are outperforming. So it is not a one-to-one relationship, but it's pretty close. And you can see that there's a clear, at the very least, a clear correlation between value stocks doing well and between interest rates going higher. And the reason is because it makes sense, right? Value stocks are sort of designed to do better in higher rate environments. And when rates go higher, growth prospects of a growth company are just less attractive because you have higher interest rates to compensate yourself. And so growth stocks tend to do not as well. Now, what I would say is those are big generalities. So there could be certain value stocks that underperform dramatically, and there could be certain growth stocks that outperform dramatically. I think one good example could be a stock like a big defensive tech company like a Microsoft or an Apple or something. Those could certainly do well because people might still be in technology, but will get out of the real speculative stuff and go to the more defensive, blue chippy technology names that'll probably ride things out. Microsoft has tended to do well in a lot of different environments, regardless of interest rates. So, yes, those are absolute tendencies. Yes, I would answer yes to those questions that you asked, but not using the word will. I will say, will they most likely? Absolutely. Will they absolutely? I don't know for sure. Next question. Hi, Dave. I know you spoke about adjusted versus unadjusted charts last week, and it also touched upon on a decision point video this week. Great. I would like to know. I would like you to know if you prefer looking at adjusted or unadjusted charts for selecting key areas of price for support and breakout levels. Yeah. So Aaron Swedlin and Carl Swedlin at Decision Point did do a video on that this week. I checked that out if you missed it. Arthur Hill has done some videos on adjusted versus unadjusted data pretty regularly, and I encourage you to check that out for sure as well. What does that mean? So if you look at weekly data on something like Verizon, right? This is VZ. I don't know if this is a great example, but I'm going to try it. I haven't looked at this in a while, but probably a good example. So when I look at VZ and just bring up the ticker and I look at the last 7 years of history, we're adjusting the data, which means a company like Verizon, which pays a pretty consistent, pretty high dividend, it's going to affect the stock price, right? So every time a company pays a dividend, you actually take value away from the price of the stock. There's a gap lower on the stock, and that difference is paid out in the form of a dividend. That's how you adjust for it. Now, a long time ago, our founder Chip Anderson was debating this with John Murphy, who really was the inspiration for much of our technical content on StockCharts.com. And John's comment was the problem I have with adjusting data like that, with the data, with the stock price moving just because of a dividend, is because I want my indicators to be driven by investor behavior, not by some capital change like a dividend or something. So we should adjust all of our data so that all the indicators like RSI and moving averages and everything are showing you the trends based on the total return, or based on the adjustments for dividends. So you actually adjust the historical data to do that. Now we allow you to unadjust the data. So if you do underscore VZ, the price actually looks a little bit different because basically once you take the dividend out, it's usually going to look flatter on a dividend paying stock because this shows that the price isn't going to move as much. A lot of the return, a lot of the movement you're seeing in the prices because of the dividend that the company is paying, and because you wrap that into the adjustments in the price. So my short answer is, if I'm looking at trends, if I'm looking at most data, I often and pretty much always use adjusted charts, especially on daily charts. I think that's pretty fine for most things that you would look at. If you're looking at pure support and resistance levels, it is a much better idea to do underscore the ticker, because that is going to show you where the stock actually traded at some of these historical levels. That'll show you the actual buy and sell levels that traders and investors were using there. So I actually use the two of them differently depending on what questions I am trying to answer. Next question. Hi, Dave. Can you discuss how to find a chart that identifies a Martin Zweig breadth thrust on the final bar? I wonder if we just had one off of the bottom. Very, very good question. So Marty Zweig was an investment strategist decades ago. He would make comments, and it was sort of, it's funny now, but he would make comments and the market would move immediately. He had that much sway over the financial industry, right, and the financial markets. there was such a focus on people would hang on the words that he would share. He came up with this idea of what's called a Zweig Breadth Thrust. A breadth thrust is basically we have a big influx of buying that propels things from a bearish configuration to a bullish configuration. The way he decided to measure that is by looking at advancers on the New York Stock Exchange versus the total listings on the New York Stock Exchange and taking a 10-day exponential moving average. So this chart that I'm showing you actually combines those and shows you basically how they are how that is coming up. What he would look for is if it gets below zero point 0.4 on this ratio, that would basically be initialize the signal. Then you have to get above 0.62 or get to 0.63 within, I think it was 10 trading days, 5 or 10 trading days, and I forget which one exactly, but I think it was 10 trading days. We actually coded this indicator using this ticker. So if you hit pause, exclamation point BINYBT, we actually code this particular combination as its own indicator. You're welcome to add that as a chart. The short answer is no, because the breadth did not get high enough. If you Google Zweig Breadth Thrust, you can see some really good articles. And Walter Deemer, by the way, if you go to walterdeemer.com, he was a technical analyst at Putnam Investments in the 1970s. He wrote a really good article about breadth thrusts and what that actually represents and some different ways to try to measure that. That's all the time we have for questions. Listen, thank you all so much for sending those in. Keep them coming, and we'll get to more Tuesday of next week. We need to wrap the show, folks. Go to the 3 in 3, 3 charts in 3 minutes. Let's get to some of the top themes I think you should be focusing on over the weekend. Chart number 1 is looking at interest rates, but in a little bit of a different way. We're looking at the yield on the S&P 500 versus the yield on Treasury bonds. And what I'm doing is actually doing the yield, basically the dividend yield. So what are you getting compensated for? What are you getting paid out in the form of dividends owning the S&P 500 versus what are you getting owning the 10-year Treasury bond? As you can see, for much of 2020 into the beginning of 2021, you were getting more from owning stocks than owning bonds. So the question is, why do you need to own bonds if you're getting such a great payout just from owning stocks and getting that normal, the sort of that dividend component, that income component? That has completely changed. You can see that the spread has been going lower. It's now net negative, which means as rates have gone higher, fixed income instruments, even treasury bonds and corporate bonds, pay obviously a higher yield than this. You're starting to get more and more of a payout for owning debt than owning stocks. What happens is bonds start to become more and more attractive when you get a higher yield component. You get better compensation or better better payout for owning some of those bonds. Might be an important chart to watch there to think about stocks versus bonds. Chart number 2 is the momentum ETF. We're doing the relative strength of momentum, MTUM versus SPY. People love to bring up this chart and say, does this mean the technical analysis doesn't work because the momentum ETF is going down so much? The good answer is no. That does not mean the technical analysis is not working. What I have found is while I certainly use price momentum and many technical analysts do, I think the fact that this ETF goes down so consistently in the last year or two is really more about the configuration of the ETF than anything else. The largest sector that the MTUM holds is technology. It's about a third of the fund is technology. About a quarter of it on top of that is financials. Now, tech and financials have not had a great stretch here. Financials struggling because the yield curve has been flattening. Technology struggling in a higher rate environment, particularly since November. So this fund rebalances in the fall. So right about here, it's loading up on tech and financial stocks. And then those two sectors are struggling as energy is doing so well. Don't energy back here when energy is not doing so well. So it's tough. It lags behind. And this is why momentum works. But it's more about how you're rebalancing your portfolio and getting into the names that are leading. Finally, US versus global stocks. This ratio in the top is going higher fairly consistently. It pulled back in January, February, but now making new swing highs this month. That is because of the US dollar. In green here at the bottom, we have the strengthening of the US dollar really since the beginning of 2021, pushing onward and ever upward, resuming that uptrend and pushing higher. As long as the dollar continues to strengthen, US is outperforming non-US. There's no great reason for a US-based investor to be looking outside the US, except opportunistically. But as a broad allocation, doesn't make a ton of sense. Folks, that is our show and a wrap for this week. Thanks for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.